What's up everybody, Genix Dividend Investor here. Some people claim dividends don't matter, but riddle me this, Batman. Why did the biggest, most powerful, and influential banks in the US, led by some of the sharpest financial minds literally on the planet, just announce a round of significant dividend hikes, with some being truly massive? Like, why did Wells Fargo announce a 12.5% increase? Why did Goldman Sachs, the company I'm long in, announce a huge 33% dividend hike? Stick with me and I'll show you exactly what the dividend naysayers are missing and why the management from top financial institutions know that dividends matter. Now, if you followed my channel, then you know that I'm actually not a big fan of financial stocks due to what happened in 2008. Let's do a quick financial history refresher. That'll help explain why banks are hiking dividends today. So in the early 2000s, banks increasingly made risky home loans to borrowers with low creditworthiness. Wall Street bundled those loans into complex securities and sold them as safe investments. But when housing prices fell and borrowers began defaulting, the whole system started to collapse. I actually had a relative who lost their house mortgage at the time, and to this day they still rent rather than own. The financial crisis of 2008 exploded as Lehman Brothers failed, panic spread, and the global financial system froze. To contain the damage, the US Treasury stepped in to calm global markets and forced 9 major banks to accept bailout money to stabilize the system and minimize panic. Now, a good question to ask is what probably would have happened if the government hadn't taken that aggressive action? Well, I think we could have seen a domino chain reaction of weaker banks failing and then bringing down others. It was a nasty time, and since many banks were stressed, they became unwilling to lend money. And when banks don't lend, that can mean businesses can't make payroll or invest, and consumers can't get mortgages, car loans, or other credit. All of that can quickly lead to the economy seizing up. That matters because the US financial system is deeply connected to the global one. If lots of large US banks had failed, banks around the world would have faced massive losses, likely triggering a global depression, not just a recession. Still, the 2008 crisis caused over 8 million job losses in the US, and if more banks had failed, then I imagine unemployment could have skyrocketed, contributing to a probable depression. Plus, if the public lost confidence in the banks, more people might have rushed to withdraw their money all at once, creating cash shortages and even fueling more panic. So bottom line, while the government's forced bailout was unpopular and controversial, it did help restore confidence in the banks and likely prevented a catastrophic collapse of the global economy. Some of the big banks didn't need or want the bailouts, but they claimed they were pressured to take the money so the weaker banks wouldn't be stigmatized or seen as being in trouble. The government also fined multiple banks for enabling the crisis, but still handed out loans and such to save the system. Goldman Sachs and JP Morgan repaid their bailouts quickly, both because they could and to avoid giving the government any real or perceived influence over their operations. I've always looked at GS and JPM most favorably due to their dominance in each of their respective financial niches. Like Goldman Sachs takes the crown when it comes to investment banking and asset management, and is widely viewed as the most prestigious investment bank globally, often setting the tone for the industry. They're known for their elite client base, from corporations to governments to very high net worth individuals. And then JP Morgan is the goat of banking for both everyday consumers and large institutions, including corporations, governments, and more. JP Morgan is the largest US bank by assets, with leading positions in retail banking, commercial banking, credit cards, and investment banking. It's led by well-known CEO Jamie Dimon and is widely recognized for its operational excellence and fortress-like balance sheet. Anyway, that whole financial crisis left a sour note in my mouth, and I've only ever directly invested in Goldman or JPM, as I really like both of them, though I currently only hold GS. I'll probably get back into JPM at some point in the future, as having 2 financial gorillas in my portfolio probably makes more sense than just having one. But building up my Goldman position paid off as they've performed well, and they just announced an insane 33% dividend hike a few days ago. And as someone retired and living on dividend income that pays my family's expenses, I was really thrilled by their move. Take a look at the last few years of my Goldman Sachs dividends I've received to understand how great they've been to me. So in September of 2022, they were paying me $443 a quarter. Then a year later in 2023, they hiked their dividend and paid me $488 a quarter. A year after that in 2024, they hiked and were paying me $532 a quarter. And now in 2025, they announced a 33% hike, which should take me to $710 a quarter. That's a 60% increase in payouts in just 3 years, as compared to inflation, which has gone up by about 9% in the same time frame. That's a nice buying power increase they've given me. And for reference, Goldman Sachs is my 12th largest position, worth about 128 grand of the 28 tickers I own, and you can watch my recent videos to see my entire portfolio in fidelity, as well as learn about my background and how I got here. My dividends have fortunately outpaced inflation over time, which means things like my fixed mortgage are becoming relatively cheaper. I mean, since my dividend income tends to rise faster than inflation, I'm earning more nominal dollars each year. Meanwhile, my mortgage payment stays the same, so it becomes a smaller share of my income. That's one of the advantages of having a fixed-rate mortgage in an inflationary environment, because inflation reduces the real cost of debt as long as your income keeps up with or exceeds inflation. Anyway, the next thing to tackle is, why did Goldman Sachs just do such a massive dividend hike? Heck, why would they or any big banks pay dividends and then raise them, often year after year, if dividends are suboptimal per naysayers? Is it because they're just placating their shareholders? Well, partially, but Goldman's big hike isn't just about being generous to their owners. It's a strategic play they're making after doing so well in the bank stress test they just passed, and they know that dividends drive tangible returns to their shareholders. Doing a big hike like that shows the world how resilient they are and how confident they are in their future. And if we look back at the 2008 financial crisis, regulators realized that big banks were taking on too much risk and didn't have enough capital and reserves to survive a big downturn. And to restore confidence and prevent future collapses, the US government introduced formal recurring bank stress tests. They're used by government regulators like the Fed to see how a bank would hold up under extreme economic conditions like a deep recession, massive unemployment, big market crashes, and stuff like that. They're basically a way to check if a bank could survive a crisis without failing or needing a government bailout. So after 2008, banks started holding more capital as a cushion, partly because of the new rules and partly just to be safer. Now every year the Fed tests whether banks have enough capital to absorb huge losses and still operate without putting the system at risk. From this year's stress test, Goldman emerged as a top performer and did well enough that the Fed lowered how much money they required them to hold back for emergencies. That freed up billions of dollars that Goldman could deploy, so they decided to return more capital to shareholders through dividends and did that huge 33% hike, which sends the message that they're strong, safe, and shareholder-focused. Beyond them, we saw other big boys hiking their divvies, including JP Morgan, Bank of America, Wells Fargo, Citi, and Morgan Stanley. Now to be precise, they just all announced dividend increases, so we'll have to wait for them to be approved and paid out, but I'm not aware of any cases in history where a US bank announced a dividend increase and then didn't follow through. Also note that many banks also announced share buybacks, though I'm guessing that many or all of them will end up announcing and doing buybacks at some point this year. Share buybacks are often seen as a flexible way for banks to return capital. They can adjust the amount of buybacks more easily than dividends if market conditions or regulatory requirements change. Anyway, the key point I'm making is that when the most sophisticated financial institutions in the world, staffed by thousands of brilliant financial minds, make a specific capital allocation decision, i.e. not to only pay dividends but also to increase them, then the people who argue that dividends are suboptimal or wrong or irrelevant or whatever ultimately kind of look like the guys who watch the NFL at home and scream at coaches' decisions on TV. And sure, I'm sometimes one of those armchair quarterbacks myself, but at least I realize that the coaches are where they are because they're amongst the best of the best, making decisions that are usually correct given the circumstances. So when someone implies that Jamie Dimon is making poor capital allocation decisions by paying and hiking dividends, then to me that's kind of like saying that the coach who has 5 Super Bowl championships is making suboptimal calls. But at the same time, it was the management of the banks that got us into the 2008 crisis to begin with, so it's understandable that some remain skeptical of their judgment, no matter how strong their track record. Now, of course, everyone makes mistakes, from coaches to CEOs, but paying dividends is something that's gone on for a very long time. Now, one might argue that perhaps it's just the current batch of bank CEOs that are making bad decisions about paying dividends. But if you look at Goldman, you can see that it had another CEO over the last 2 decades, and both of them paid and hiked dividends. Or to put it differently, on one side you have real-world financial leaders making pragmatic decisions to pay and raise dividends year after year. On the other side are the dividend skeptics, operating in the theoretical world of Miller and Modigliani's 1961 theory of dividend irrelevance. In their paper, Dividend Policy, Growth, and the Valuation of Shares, they argued that under ideal conditions, a firm's dividend policy has no impact on its value. This is what's known as the dividend irrelevance proposition, which many dividend naysayers often point to. The theory basically says that in a perfect world with no taxes, no fees, and fully rational investors with no unusual market behavior, it doesn't matter whether a company pays dividends or not. In that world, investors should be indifferent between receiving returns as dividends or through stock price appreciation. And if it doesn't matter if a company pays dividends or not, then that means dividends won't affect the company's value or how rich shareholders can get. Another point is that if investors want cash, they can just sell some of their shares and create their own homemade dividend, whether the stock pays divvies or not. The naysayers would argue that creating your own homemade dividend is better because then you can control when and how much income you get, which also means you can optimize your taxes better, all of which has merit. Getting a dividend is kind of like forced taxation because you're taxed on the income in the year it's received, even if you immediately reinvest it, unless it's in a retirement account, though the naysayers seem to gloss over that part. Though I'd also say that actually it's worse than that because the company's also taxed when they get the income and blah blah blah. Plus, there's the fact that while qualified dividends are often taxed at preferential capital gains rates, non-qualified dividends are taxed as ordinary income, which can be significantly higher. The naysayers also say that if the company instead retained and reinvested their dividend earnings, the stock price would theoretically increase by a similar amount. That all being said, the dividend irrelevancy theorem depends heavily on a set of idealized assumptions about perfect capital markets. Like, it assumes we're in a world with no personal income taxes on dividends or capital gains, and no corporate tax, and that firms would probably prefer not to pay dividends if they're tax disadvantaged. It assumes all investors and managers have the same complete information about a company's future prospects, investment opportunities, and cash flows. It assumes investors are perfectly rational and focus solely on total returns, not on the form of the return, and they're not influenced by behavioral biases. And it assumes the company's investment decisions are fixed and not affected by its dividend policy. If a company needs cash for profitable projects, it can also raise it costlessly through new share issuance, regardless of how much it pays in dividends. In essence, M&M's main point was that if all market frictions are removed, then it doesn't matter how a company distributes its cash, whether it's through dividends or reinvestment. It's like, kind of think of a company as a pizza. Cutting it into different slices doesn't change the amount of the pizza. And so in the same way, the method of distributing cash does not affect the total value of the company. Thus, M&M would say that companies don't need to worry too much about whether they pay out profits as dividends or keep the cash, because what really matters is how well they invest and grow the business, as that's what drives value. Their theory provides a useful starting point, even though in the real world, factors like taxes and investor preferences often make dividends more relevant. And note, Miller and Modigliani won a Nobel Prize in economics for their overall contributions, so they aren't some quacks on YouTube like I am. Another core argument they make is that dividends aren't free money. A company's value is based on the present value of its future earnings, whether those earnings are paid out as dividends or kept within the company. If a firm pays a dividend, it has less cash, which means its asset and equity value decrease by the same amount. So while you receive cash, the value of your shares falls by an equivalent amount, at least in theory. But stay tuned, because real-world data actually contradicts that part of their argument. And back to the pizza analogy, it's like taking a slice from your own pizza. You now have a slice in your hand, but the pizza in front of you is smaller. Your total wealth, which includes both the cash and the value of your remaining stock, stays the same in theory. Okay, now let's talk about how that theory breaks down. There's an interesting phenomenon known as the ex-dividend date anomaly, where the stock price doesn't fully drop by the amount of the dividend on the ex-date, even though standard pricing theory says it should. This discrepancy is part of why I say dividends can feel like free money, and in some cases they might actually be, because the market tends to price them more favorably than theory predicts. Like in theory, when a company pays a $1 dividend, its stock price should fall by exactly $1 on the ex-dividend date, since that cash is no longer part of the company's assets. But in reality, academic studies have shown that the stock often drops by only about 80 to 90 cents for every dollar of dividend paid. This means investors may retain part of the dividend's value in the share price, effectively receiving more total value than the theory would predict. This price adjustment is not enforced mechanically by the exchange. It results from market behavior, including the actions of human traders, institutional investors, and algorithmic trading that respond to the fact that the stock no longer carries the right to the dividend. Researchers believe this anomaly exists because of factors like tax differences between dividends and capital gains, and/or due to transaction costs, and/or due to investor preferences, because some folks like me prefer dividend stocks. Okay, now let's talk some more about the homemade dividends part of M&M's theory. While M&M's theory treats selling shares and receiving dividends as financially equivalent in a perfect market, this overlooks some important real-world differences. First, dividends don't destroy value. They simply return part of the value that has already been created, while leaving your ownership stake and your claim on future earnings intact. In contrast, selling shares to generate cash reduces your ownership in the company, which can dilute your exposure to future value creation. So while both actions provide cash, dividends allow you to maintain your position in the business, whereas selling shares requires giving up part of it. Another difference, at least to me, is that not having to sell shares makes things a lot less stressful. And then another is that dividends make it easier for my family to get cash without needing to know anything about investing or when to sell, and I'll elaborate on that in a bit. Bottom line, there are plenty of advantages to real dividends. And all that helps explain why so many people prefer dividends over capital gains, even though theory says it shouldn't matter. A lot of people like me, who some naysayers might call irrational, choose to focus on dividend-paying stocks in retirement. I care about consistent income, and I also care about total return. And like many retirees, I value predictable cash flow. It pays for my living expenses, gives me peace of mind, and makes it easier to stick with my plan, which is a big reason why I like dividends. This real-world preference for how returns are delivered, combined with things like taxes and not wanting to sell during market dips, shows that investors don't operate just inside a clean textbook theory focused only on total return. It's a clear example of how personal needs and priorities don't always align with what academic theory assumes. Beyond that, I've also shared how my health has influenced my preference for dividends and how I want to make sure my wife and kids continue receiving income even if I'm not here. My dividend income has done that so far, and I'm confident it will continue to do that long after I'm gone. Anyway, even though I prefer divvy companies, I always tell people to focus on investing in quality businesses, whether they pay dividends or not. That being said, now that I've been retired for 5 years living off dividend income, I feel even more confident in the approach than when I first retired. And plenty of investors take the same route, and that kind of behavior challenges the assumptions behind M&M's theory. So while I understand the logic behind the theory that it shouldn't matter whether a company pays a dividend or not, the real world clearly works differently. In practice, dividends provide emotional comfort and practical benefits that capital gains simply do not. Like, I've lived through stretches where stock prices went nowhere for years, including the last decade, and I can't overstate how good it felt to keep getting steady dividends while the market just treaded water. And while it's easy to say that people can just sell shares to create their own dividends, the reality is that it's not always that prudent or simple. For example, my wife and kids can't really log into a brokerage account, figure out what to sell, and then make those trades to create income, at least not intelligently. I'm sure my kids will get there eventually, but my wife's just not into that kind of thing. She's never liked numbers or financial stuff, and that's totally fine. We've been married for over 25 years, and like everyone, we each have our strengths and weaknesses, not to mention our similar sense of humor. Like this weekend we were at Home Depot, one of the companies I'm long in, shopping for paint and brushes to stain our fence. She picked up this massive brush that was clearly way too big, and I said, "I feel like that's too long." And without skipping a beat, she said, "That's what she said." We both started laughing like a couple of idiots. Anyway, the fact is she just wouldn't do well with intelligently selling off our portfolio. Now, some brokerages do offer ways to automatically sell some shares, but that gradually depletes your holdings over time, which itself would add stress to my plate. And sure, you could hire someone to manage your portfolio, but that usually comes with fees and introduces a different set of risks and stresses that I'd rather avoid. Bottom line, I agree with some of what M&M theorized about, but the assumptions aren't realistic. I mean, their theory works on the chalkboard, but in real life, dividends provide emotional and practical value that capital gains can't easily replicate. And saying that shouldn't be controversial because Miller himself acknowledged limitations in his theory later in life. He admitted that once you introduce taxes, transaction costs, behavioral biases, and practical realities, the irrelevance breaks down. So I emphasize their theory as a baseline for understanding how things can work, but they aren't a literal roadmap for corporate or investor behavior. That being said, I do agree that most investors should focus on total return, meaning both stock appreciation and dividends, rather than just chasing the highest dividend yield. And yes, a company that reinvests its earnings wisely to grow the business is something you should care about. But another mistake the naysayers sometimes make is assuming that it's always better for companies to reinvest all their earnings into growth. I mean, that kind of thinking can lead to throwing good money into projects that don't actually deliver appropriate returns. Buffett himself has said that it doesn't always make sense to invest more into growth projects, and that in some cases paying dividends is the better choice. Like, he uses See's Candy's company as an example of where dividends would be the smarter use of capital, because more investment realistically wouldn't lead to great growth. And for those of you who are about to say, well, Buffett might be okay with getting dividends, but Berkshire doesn't pay one, so he doesn't seem to really like them, then I recommend you check out my video where I walk you through Buffett's own words and show you why he believes Berkshire will likely pay a dividend at some point in the future. Okay, now with all that behind us, what do I think the dividend naysayers would say about these recent bank hikes? Well, I think they would still say that yes, it's a sign of financial health and regulatory confidence, but it's also an inefficient way to return capital, and that there's an opportunity cost of distributing money that way rather than retaining and reinvesting it. They would probably say that the banks aren't truly doing what's in the best interest of all their shareholders, especially the tax-savvy ones. They might say that companies like Goldman aren't doing hikes because they haven't identified better growth projects, and that their real mistake is not trying harder to grow. Thus, maybe those banks are making a marketing and/or investor relations decision to pay and hike dividends, perhaps more so than a fundamental financial decision. So basically, they'd probably say that banks are simply giving some of what their shareholders want, even if what they want isn't actually what's best for them. They'd contend that the banks are making a good enough decision, but not necessarily the most efficient one for long-term total return across all investor types. But again, I say the M&M theory operates in the theoretical world, not the real one. The real world has taxes. The real world often has fees and transaction costs. The real world doesn't have perfect Spock-like investors. And the real world doesn't have investors that all have the same information and competency and realities to make the best decisions, even if they could. The fact is that Goldman Sachs and other major banks operate in a messy, complex, and highly regulated reality. And obviously, the best financial minds on Wall Street understand M&M's theories quite well. Most of them went to top business schools, worked their way up through the financial system, proved their abilities, and learned how to operate effectively in the markets. Those leaders have a fiduciary duty to maximize shareholder value. CEOs like Jamie Dimon take into account a wide range of variables, and they've ultimately chosen to pay dividends, and in many cases increase them over time. And I think aligning with what Dimon does makes more sense than aligning with what the dividend naysayers feel is best. Now, dividends aren't a guarantee, but they are something that has worked out for me and countless other retirees, and I've yet to come across a single person that regrets their dividend retirement strategy, though I have met people who regretted selling shares. So bottom line, it seems pretty presumptuous to believe that an academic model, even a brilliant one, somehow understands what benefits shareholders better than the CEOs, who are actually accountable to those shareholders. The reality is that some investors prefer income, while others care more about growth or tax deferral, and that should not be treated as a minor detail in the M&M framework. Investor preferences are a powerful, real-world force that influences dividend policy across industries. Banks and other companies want to attract and keep the most valuable and stable shareholders, and that often includes income-focused investors. Giving those shareholders the kind of return they want is not just about loyalty, it's good long-term business. That kind of signal attracts capital and reassures the market in ways that just retaining earnings or even doing buybacks just doesn't always accomplish. And for companies like Goldman Sachs, which already operate at massive scale and profitability, it's not always easy to consistently find investments that will outperform what shareholders could get by reinvesting their dividends elsewhere, even after taxes. Thus, returning capital through dividends or buybacks often means the company's made a rational choice. They've realistically weighed the available options and decided that giving money back to shareholders makes more sense than holding excess cash or chasing lower return projects. Now, some naysayers might say, okay, the big banks are doing that, but that's not all companies. And to that, I'd respond that about 80% of the S&P 500 pays dividends. So are we really saying that the management teams of most of the largest companies in the world are all allocating capital poorly? Come on. Do you really believe all those leadership teams are making bad financial decisions and have been for decades? Maybe you do. At the end of the day, my main hope is that everyone invests in quality assets, and if they do that, then things will probably work out over the long run. Now, one thing I often like to include in videos like this is that I think most people who are trying to grow their portfolio will do best by simply investing in something like VTI or VOO rather than going with individual stocks. Yes, you can still do well with stocks rather than ETFs, but odds are it'll be a harder path. And if a relative of mine was going into retirement, then I'd tell them that dividend ETFs are worth considering moving their capital into rather than sticking with VOO or VTI. Yes, VOO and VTI do pay dividends, but for most people the yield probably won't be enough to live on by itself. And in retirement, I really value the time and low stress that comes from not having to worry about selling shares. But that's just me. Leave me a comment and tell me if you think dividends matter, or if you're in the camp that they don't. And regardless, please do me a favor and hit that thumbs up button, subscribe if you haven't yet, and click that bell notification. Moving on, now I'd like to show my gratitude to subscribers who've left me really nice comments, so I'm going to shout out 10 who've done just that. So thank yous go out to Yippee77777, Larry-YB7ZL, Ethan's Lee-B6L, Jeff Aragon, Eating to Live Always, Todd Hallam 9598, Marlo Frank, Stephen Diffin 5625, and then multiple nice comments from Eingram 141, and multiple from Mark Shio Prasad. Thanks folks, I really appreciate it. Now I'd like to recommend that people check out my Seeking Alpha affiliate link, which often has a discount when new users sign up. Next, I'll pitch my Fast Graphs affiliate link along with my coupon code in the description of this video, as using both will allow new users to get 25% off the first payment, even if they sign up for a full year. Also check out my Patreon page, and or consider joining my channel membership, as both have some cool perks you might like. Finally, I'll close this off by recommending that everyone join my free Dividend Discord chat server, which has over 11,000 dividend investors on it from 86 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.